A question that you may have if you're thinking about implementing the infinite banking concept is, why on earth would I be paying interest to access my own money? That's what we're going to talk about today. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel, and don't forget to hit that bell to be notified when we upload new videos twice every single week.
Accessing money to make a purchase or to make an investment has costs. Whether we recognize that or not, whether we see it or not, whether we believe it or not, there's still a cost. Ignoring that fact is basically the mindset of gravity affects everybody else, but it doesn't affect me. Well, that doesn't make it true. Check out our latest YouTube video where we talk about why you should use the insurance company's money so that your money can continue to earn uninterrupted compounding of interest.
One of the core principles of implementing the infinite banking concept using a specially designed whole life insurance policy designed for cash accumulation is utilizing policy loans, leveraging the life insurance company's money to make major capital purchases, whether that be a car, a wedding, or an investment where you could earn an external rate of return.
And you see, one of the things we sort of take for granted, or I think more appropriately, we ignore, is the fact that we finance everything we buy. Well, what do we mean by that? If you want to make a purchase, everybody thinks there are only two ways to do so. You could finance, borrowing money from a bank or a credit company, and therefore paying interest to the bank or the credit company for the privilege of using their money. The second way you can make that purchase is to pay cash. And what most people fail to do is to take into consideration the opportunity cost on using their cash. In other words, they know that if they take a loan, they're gonna pay 5 or 6 or 10% interest. But what they don't take into consideration is the fact that if they use their cash, they could have earned interest on their cash. And guess what? That's called opportunity cost. So any way you look at it, you are paying or financing that purchase. You're either gonna finance through a bank or self-finance by paying cash. And we have a saying here at Tier 1 Capital: you'll never see the interest that you don't earn on the money you used to pay cash to make a purchase.
Leave us a comment down below. What questions do you have on the opportunity cost of paying cash? Are you a believer in the concept that everything is financed, whether we see the interest we're losing or not? With traditional banking, we typically park our money down at the local bank. However, we're not earning any interest on that money, are we? The bank is, though. They're able to loan out that money at whatever rate of return they deem necessary, as many as 9 or 10 times for each dollar deposited. So what does that mean? If you finance and have a bank account at the same bank, whose money are they actually lending you? And how are you being compensated for it?
People deal with banks every day, and they accept that as normal. And then we present them with the idea of, hey, why don't you cut the banker out, set up your own pool of money that you will always earn interest on using the cash value of a life insurance policy. But you see, they have these preconceived notions of what life insurance is, and a red flag goes up and they're like, no way, life insurance bad, bank good. Tell them to keep the laugh in.
Okay, I'm ready.
And then they come back and say, why in the world would I ever pay interest to get my own money from a life insurance company? Well, here's why. It ain't your money. Your money's still in the policy, earning interest on an uninterrupted basis. The insurance company is putting a lien against your money and giving you a separate loan from their general account. That's why you're paying interest. You're paying interest to get the insurance company's money. You're using other people's money to make your money more efficient.
At the end of the day, if you're accessing money, whether you're financing or paying cash, there's a cost to accessing money. If you'd like to make your money more efficient by utilizing a specially designed whole life insurance policy designed for cash accumulation, check out our website at tier1capital.com. Schedule your free strategy session today. We'd be happy to talk about your specific situation and how this concept fits. Also, if you like this video, be sure to check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.